So the news just keeps coming. The Bay Area prices have fallen 25% since April's peak. Then we have this article, Dallas-Fort Worth home prices have fallen off their peak 10% from June. And then Barclays analysis estimate home prices could fall by another 10%. So what we're going to do today with my good friend Brent Starts is we're going to break down all this information and let you know what's happening, not only nationwide, but what's going on here in the great state of Florida, especially South Florida. But if this is the first time you've been on my channel, my name is Lee Brickey, and on this channel, we talk everything real estate. So if you're interested in buying or selling home anywhere in Palm Beach County or the Treasure Coast, or you're interested in buying investment real estate, then you're going to want to subscribe, and it's completely free, and it really helps me grow this channel. And for subscribing, here's a picture of Henry. So again, I'm joined by my good friend Brent Starr from Millennials Lending to help me unpack all this data and news articles that have hit here in January. So Brent, how you doing, man?
Doing great, Lee. Great to be back.
So we've been talking about what's going on here for the last few weeks because we're seeing the market pick up. It's really surprising to me how much the market is actually picked up here. So let's go through a few of these articles, and then I want to get your opinion on a few things. But I would like for people to understand really, just in the last couple of weeks, what's happening here and what we're finding that's coming out of NAR and from the media, because, we're seeing these price drops. I really don't believe the price drops are coming from a place of the average price of homes. They're coming from the peak of homes. What's your thoughts there?
Well, yeah. And I think, some of these statistics are coming from ask prices versus sold too. So you're seeing where, people ask, and they're reducing their prices, but they were just really, their expectations have been set at, 20-25% appreciation per year, which is unrealistic, right?
Right.
So some of that's going on. So I think that, a lot of people are like, yeah, I'll sell my home if I can get X for it. But I think that the reality is, if you're looking at the market, and you just basically take out, last 18 to 24 months, we're really at a 2019, 2020 market. Really, that's pretty much the way I see it.
And looking at, we're going to show some numbers here in Palm Beach County and Martin County and St. Lucie County in the video. I was thinking that we'd see a lot more inventory in January, but it seems like we're not. And then anything that comes on the market that is, say, in really good shape, like new, especially if it has a pool, it's gone fairly quickly. Yeah. And we're seeing new construction just flying off the shelf, because I think the Florida real estate market, as we said in the past, is a little bit more insulated than the rest of the country because of the amount of people moving here and the amount of companies that have moved here already that are still hiring. So let's look at a few articles here and just kind of burn through them and not spend a bunch of time. But pending sales rise for the first time since May 2022. So we're seeing sales going up. They're still down 34% year over year. But here's the thing, Brent, when we look at this stuff down year over year, who wants the market we just went through in 2020, 2021 and 2022? No one. I mean, It's an unsustainable market. Prices have gotten ridiculously high. The Fed held on to almost zero rates for way too long. In my opinion, it was a political move, and they've put the country in a really bad spot where now the Fed is now controlling the market.
Right. Yes. And they're meeting tomorrow. Actually, they're meeting today and tomorrow. And we're expecting a quarter point hike. And then maybe a pause or just one more quarter point hike. That's pretty much baked in right now as far as the Fed futures numbers. And so, like you say, Lee, they held on to the zero interest rates for way too long. And, hey, this inflation, it's transitory. And then all of a sudden it's hitting the panic button. And then it's 3/4 bumps, almost a full percentage point at every meeting for, 4 or 5 meetings. So that's it takes about a year for those rate hikes to really fully impact the economy. So I think, what we're going to see, the mortgage market, by the way, has already responded in the longer end of the yield curve, right? So even though, Fed funds is a short-term interest rate, 30-year mortgages are not. It's a 30-year investment for an institutional investor to buy that mortgage. I think what we'll see, interest rates have already backed off. We were almost in the mid 7s 3 months ago, and now we're down to low sixes, if not lower. So that's what we're seeing anyway from the mortgage market. They're already responding, anticipating that yield to drop on the 30-year treasuries and 30-year mortgage market.
I just don't, I was watching I told you about, I was watching a real estate investor I have some respect for. He's a YouTuber, and they were talking about how they lost $200,000 in the market here in South Florida trying to flip houses. And my thinking was, well, who's trying to flip houses when you don't even know what real prices are, right? Because I talked to some agents and they're like, oh, these are real prices. And I'm like, no, they're not. They're not real prices. I mean, you have too many bidding wars for this to be real. So too many people throwing cash around, and that's going to end. And when that ends, we're going to roll back into a regular market. And that's what we're rolling back into right now. Now, neither one of us believe that, and no one in the entire industry believed that interest rates would get this high. But one of the thoughts were that, I could see interest rates going to 10%. I think if you think interest rates could go to 10%, you're not paying attention to the equity markets, because I've said it before that the Fed doesn't really care about if you and I have a job, or if we lose our jobs or our houses or anything else. I mean, their job is, one thing is to keep inflation down, but their other job is to make sure they don't collapse the entire market either. And these are people, and they plan to move on with their lives. And if they collapse the entire equity markets and the real estate market after they said the things that they did, like transitory inflation and all this kind of stuff, I really believe that any career after the Fed would be completely over, right? I mean,
I agree. Yeah, I mean, they really, you're going to have to eat crow, because I mean, I think you're right. They really had to do something, and do something quickly, because inflation was quickly becoming a serious issue. Like we've talked about before, it really doesn't impact the wealthy. It impacts the middle class.
And I told you today, we're getting a lot of calls right now from first-time buyers. I'm probably getting one almost every day, and a lot of them are looking for homes in the 300s. And unfortunately, there's really nothing in the 300s, and especially here in South Florida, if you end up buying something in the 300s, like 350, 360, you're getting a fixer upper. And the problem is more than likely that roof needs to get done too. And that runs you into an insurance problem, which we need to get our insurance agent on eventually and have a call with her so people can understand what's going on here with insurance. But if you're purchasing a house less than 5 years old, your insurance is going to be somewhere around $1,800 to $2,200 a year. If you're purchasing a home with a roof over 10 years, 15 years, especially 15 years, you're looking at, $3,000 to $4,000. And that money you could be putting towards a home. So fixer uppers are really sitting on the market right now, or stuff that doesn't need to be fixed up is selling. But the 350 market is kind of gone until, especially in where it used to be everywhere even at the beginning of last year, but in Port St. Lucie, it's gone until they start building some townhomes, which that's about to happen. Cadence is about to build a whole bunch of townhomes, Mattamy Homes and Tradition. So we'll see what happens in the future with rates, but I don't see rates going past where they are now. I think they could fluctuate a little bit up and down, or they could go sideways, but we should see rates improving, don't you believe?
I believe so too. Right now, you've got it's called the yield spread between the 2-year Treasury and the 10-year Treasury. And what that means is basically there's a higher yield, in other words, a higher interest rate paid on 2-year Treasury bonds when the United States borrows money, right? They're paying, that spread is 0.75%. Now, as opposed to the 10-year Treasury, which is providing a lower rate of return, which is around 3.5 right now. So the reason that happens is people are betting on the longer end of the yield curve coming down. In other words, hey, that 2-year Treasury is it's attractive now, but we think rates are going to come down. That's not going to be the norm. And the longer in the yield curve, we're going to be happy with 3.5%. In the market, the bond auctions the last couple of weeks have been successful. And so it's indicating that's screaming, if you will, inflation, or not inflation, but a recession.
Right.
That, hey, things are going to slow down. And so when things slow down, then eventually what happens is the Fed has to reverse trend, right? They've got to pause, which I think we're seeing right now. We're going to see a quarter point bump tomorrow. It's a 98% or more baked in right now to the Fed futures market. So it's a foregone conclusion. They don't like to surprise the market. So I completely believe that's what's going to happen tomorrow morning. But then I think we'll see a pause time, and then we'll see, kind of a look-see and see at what time do we begin to cut rates again.
Let's jump back into this real quick. Other good news coming out. Like I said, this came out January the 27th. Housing market has started to recover. While the phrase is not out of the woods yet, it's still used. Redfin economists say that market probably hit its cycle low through the second week of November. So that they think that the prices are kind of bottoming out, and they're seeing the market begin to pick up a little bit here. And then housing confidence up a bit from October lows. So Fannie Mae sentiment index hit a record low, but is rose in December due to increased expectations that mortgage rates and home prices may decrease. And then we see new home sales increased by 2.3% in December compared to November, but down again 26.6% from December 2021, which we don't want those kind of numbers, because right now we're in a housing affordability issue, and that would just continue to make that worse and worse and worse. So we want things to settle down a little bit. And then we have this 92%. I mean, we've been saying this for a while, Brent, and I just want to, this is just came out January 25th. 92% of millennial home buyers say inflation has impacted their purchase plans, but most are plowing ahead anyway, study shows. And we're seeing this on the ground right now. We have a lot of millennials working with us, especially in this state, where, you have engineers, all types of high-paying jobs. These millennials are making very good money, because I read an article the other day that a lot of the baby boomers retired over COVID because they just didn't want to deal with it, and they figured, okay, let's just get out, right, and retire. And so millennials have taken those jobs, and because they're educated, and these are high-paying jobs. This is something that is a big deal, because millennials are starting families now, and they need housing. And then let's go through these numbers real quick, because one of the beatings I got from my video was, hey, things are down. So we were going through 2020, 2021, and the beginning of 2022. Agents were looking at what houses were actually selling for, right? Because that's how you had to gear the market. You had to see what they were actually selling for. Now what's happened is we're seeing price decreases. So we need to look at the medium sold price, because that's what we're going to average the market on. And that's also how we're going to look at what the appraisal would be on the house. And appraisals didn't matter for almost 2 years, because there was so much cash in the market, and lenders were watching the market move up. So they were just doing appraisal waivers. So we did tons of those, right? Because people were coming in with half down, 20, 30, 40, 50% down if they were financing. And then there was just tons of cash business. So we've kind of gone back to that median sell price. This is Palm Beach County. So year over year now. So we're going on this medium sales price. The difference between December last year and December 2021, we were still up 18%. Right. And you can see that inventory was increasing, but not by that much. And then you go to Martin County, right? And you see number of homes went up 100, less than 100, 4.5%, right? But we're seeing 13.8% increase in this market also. And then we go to Port St. Lucie, where you're looking at almost a 24% increase in equity from last year, from last December to this December, and inventory went down.
Exactly.
And let's go through that. I mean, look at these numbers, man. I mean, this was 2022 price slowdown, but look at the profits here in Florida. I mean, Fort Myers was up 51%, Ocala up 49 to 82%. That one of my best friends in the world, Ron, lives there, and it's like, it's crazy, right? I mean, that's just a horse town, right?
Right.
Naples 47 to 74%. Port St. Lucie 62% to 62.8% to 84.8. I mean, 84%. Miami 42 to 61. Orlando 42 to 62. Tampa 43 to 73. 43 to 58 in Jacksonville. These are the hot markets in Florida right now, where retirees are moving and where people looking for jobs are moving. And look at these numbers. So you think about all this equity, where's a foreclosure coming from?
Yeah.
If they lose their job, right? And if the market actually came down, let's say it came down 20%, you still are sitting on a ton of equity because you had equity from 20, you've been in the house. So if you were in the house for
2021,
right. So in some markets, you're upside down if you bought last year, but in Florida, look at these numbers are ridiculous.
One of the articles I saw, Lee, was if you bought FHA, last year, you'd be upside down, but you realize that, you finance the upfront mortgage insurance. So you start with just like basically 1% equity.
Right.
You know what I mean? So if it moves the needle just 1%, I don't think that's any reason to walk away from your home.
Because they bought it FHA to stay in it. They're not investing.
Right.
If they bought the home FHA, most people are buying to stay in it.
It's owner occupied.
And then talking about foreclosures, these are the foreclosure numbers. This is it, right?
Yeah.
So 2008 we saw was a buyer's market. Now I will tell you, we are in a balanced market in our markets right now. Palm Beach County and Martin County and St. Lucie County is more of a balanced market than it's ever been. But if we look at foreclosures, I mean, 2022 we have some more foreclosures, but look at 2019, look at 2018, look at 2017. I mean, Florida, we were in bidding wars in these years, especially in Jupiter, Palm Beach Gardens, Port St. Lucie. When you ran into a really nice house, you were in a bidding war. Wellington, bidding wars in Wellington, bidding wars in Boca. Hot markets, Delray, hot markets were having bidding wars.
Yeah.
Since 2016. So if we're looking at foreclosures and real estate investors, I can tell you, I have a ton of friends that are investors, and that's all they do for money, and they're not near finding the foreclosures that they need in this state. They're just not there. And this is nationwide. So foreclosures are still super low. And then we run into this realtor.com, which they say that 5.5 million homes are needed. Bank of America says 4 million homes. I like Freddie Mac because they're really tied into the mortgage industry, but they say 3.8 million homes are needed to bring the market up to a normal market. John Burns Consulting 1.7 million, and Moody Analysis 1.6 million, Morgan Stanley 2 million. You can look at these numbers and say, well, I don't agree with this one, or I don't agree with this one, but the consensus is what you need to take a look at. And the consensus is we still don't have enough inventory for demand. Right. And that's going to keep the market from falling to crashing or falling apart, which a lot of people are I think they're hoping will happen. But I don't think that's a good thing either for buyers or sellers. You don't want to destroy something so you can get a good deal, because then it just doesn't, there's no win-win in that, in my opinion. So I think that's not healthy.
No, you're right, Lee. And I think, it's really important to point out too. I mean, basically in very general terms, in, supply and demand terms, there's a housing shortage. There's just not enough homes. There's not enough roofs, and you've got to live somewhere. So either you're going to own or you're going to rent. And so, a housing shortage is a market where rates on rentals go up as well.
I mean, so you have active properties on the market here. You can see this graph right here. This is active listings right now. Look at new listings coming on the market. This is nationwide in December. Now, obviously, December is a slower month. So let's look at January when the numbers come out. And again, I go back to the fact that if a house is sitting on the market, because we're starting to get some people that want to, some clients that want to list, right? And my thing with them is, okay, we need to make the house perfect, whatever that takes. Folks are walking into homes right now. They are not wanting anything that they have to repair. And if the house doesn't look very inviting, they're out the door looking at the next one. Because they're, and then a lot of this inventory sitting on the market is for sales, meaning that the people have to move, they've passed away, or they're going into a retirement home.
Right. It really life events. It's all we're seeing, or people moving here from other areas, transfers, things like that.
Right. You can see listings are now below previous years. So we have less listings on the market than 2021, 2020, 2019, 2018, and 2017. So that's what's going to keep foreclosures from happening, even if people lose their jobs. And let's jump into that real quick, because that's a big deal that people are talking about is job loss. Well, most of the job loss are in the tech industry.
Right. And what's Miami? 1.7% unemployment, something like that. I mean, you get some, nationally it's way low, but in Florida in particular, it's extremely low.
Right.
So I just don't see it.
I don't either. So housing experts say sellers are absolutely having to negotiate. So let's get into this, because this is the key here for first-time buyers. I have people saying, oh, don't buy on my comments, right? The guy's just trying to sell houses. They just want to sell homes. And I mean, obviously this is our job, right? I mean, this is what we do for a living, but I'm not out here trying to put people in a situation that's bad for them. And we never have done that. And you can go look at all of our clients where they've left testimonials and things on Google and see who we are. But with that being said, it is my belief and opinion that if rates get into the fives and to the low fives, it's going to become another buying frenzy. Yeah. I just don't see it, how it can't happen.
They're going to see it, a lot of it's relative, right? So if you've seen 7.5 for, a few months, 3 months, and then you start seeing the sixes, and you, like you say, Lee, you get in the fives and the low fives, it's back on, because relatively it's from recent memory, it's much lower. And to your point on this in the slide you brought up, your sellers are absolutely having to negotiate. Well, right now we're seeing, like you see, FHA loans being accepted, where the FHA, VA financing.
Right, we haven't been able to do an FHA. I put a video last week. We haven't been able to do an FHA or VA loan in 2 years. I mean, there was no way of getting one done unless they're coming in with heavy cash, so they're not buying a VA loan for nothing down. And so right now, two things. Number one, new construction's given massive incentives. I was just at Mattamy today with a client. They're offering $40,000 on a villa in Tulare. 40 grand. And then you're seeing 25 to 30 35,000, 25,000 here at this builder. I mean, it's across the board, these builders. So when you go into the seller here with a existing home, they're going to have no choice but to do incentives. I mean, you're going to be able to ask for a seller credit, and we're going to ask for the world. I mean, I'm not afraid to ask for 20 grand. I mean, we've gotten $15,000, $20,000 seller credits before in the past, depending on how much the house is. But we can, we can at least get someone 10 or 15,000 towards their closing costs, or to buy down the rate. So what does 10 grand buy down these days?
Yeah, I mean, you're going to buy it down. Like, it depends on the loan amount, right? The loan
Right.
size, but you're buying the rate down in full, half or more. Depending on the loan amount. It makes a difference over on the long haul, especially if
Well,
you're
it
going to
makes
keep
a
it for
difference right
25,
now
30
too
years.
for the amount
Yeah,
of house you can buy. So if
right.
if the house is a little out of their range,
Mhm.
and we can buy the rate down, we put them in their range.
Well, Lee, 3 or 4 years ago, you were bringing deals to us all the time with seller credits when no one else was. You were negotiating those and getting people in homes. And I think that market is, coming back. And so I think, just having a realtor that understands the market and understands that, hey, this is where we can get the deals done and negotiate and put people in a great spot. Yeah, it's slowed down, it's softer, but there's an opportunity in that, and you got to understand what that opportunity is, which you do.
Because here's the other thing. This just came out by CBS Miami. Residential rents in Florida continue to rise, even though costs dropping in other states, new report finds. Right. So this is, from November. It's
Right.
talking about, rents are still up, and we're seeing rents still up. I mean, it's very difficult to rent a house here. You're going to have really good credit. You're going to have first, last, and security, and they're going to want you to sign a year lease. And
We're doing those DSCR loans for investors right now, Lee, and we're still getting those done. In other words, the rents are paying for the principal,
at
interest,
these
tax, and
rates,
insurance.
that's
Yeah,
crazy, right?
yeah. Those are
And
still
so,
try that anywhere else in the country. It's just not happening because the rents are higher. Yeah.
right. And it says more builders are cutting prices and offer incentives, but still not to 2008 levels. So let's talk about what's out there right now, what you can do for clients who are looking to buy with these incentives. Kind of give some understanding of how this helps you get a loan done and helps you help the client right now.
Absolutely. Well, a lot of times people are short, like the down payment or closing costs or both. And so by having a credit, certainly that we can, remove those off the closing sheet if the seller's going to pay for those costs, the closing costs, or help with the down payment. A lot of times we're doing gifts. A lot of times right now we're getting people that borrow from 401ks, things like that. But so these credits really help having to do that. You don't have to dip into your own funds. You can use that to buy down the rate, for example, you're referring to earlier, Lee. There's several strategies. You can do a 3-2-1 buy down, with a large enough credit. To give you an example, we're in the low sixes right now as far as conventional loans are concerned. You can buy that 3-2-1 buy down, can buy that rate down to 3.25 the first year, then it goes to 4.25, then 5.25, then the fourth year it goes back up to 6.25. So it's not an adjustable, where you're going to land for the last 27 years. But the first 3 years can be bought down. The opportunity in that, frankly, interest rates were 3 or 4 months ago were 7.5, and now we're down to the 6.25 range. So you can get immediately those lower rates, and then as rates continue, I believe rates are going to continue to go down as the Fed pauses. Tomorrow there's going to be a 1/4 point bump to the rate. I can almost guarantee that. That's fully.
But that's not
baked
going to
in.
make mortgage rates go up. That's just affecting credit cards.
Credit cards, right? Anything tied to prime, so HELOCs, those would be affected. But the mortgage market, the long end of the curve, we talked about it earlier. The 10-year Treasury is yielding far less, than 0.7% less than a 2-year Treasury. In other words, the bond market knows that long term, it's better to lock in at 3.5% 10-year Treasury. That's a government bond. It's a borrower. It's the U.S. debt, if you will, right?
Mhm.
Because they know rates are going to be going down, and that'll be a solid investment. We watch the Treasury auctions, by the way. They're coming in at A minus, B plus. I mean, there's a lot of activity, a lot of interest in those bonds at those prices. And so the bond market, which is I always say the bond market's the smartest guy in the room, and so
Right.
they're the ones that watch this stuff day in and day out. They know which direction mortgage rates are headed, and and long-term yields and all that. So the bond market's pricing in a slowdown in the economy and rates pausing certainly in the next no more than the next meeting. I think we might see a 1/4 bump at the next meeting, and after that they're definitely going into a pause for sure. And then we'll see, because there's a year lag on these rate hikes that were 0.75, 0.75, 0.75. Those are strong hikes, and then it's pairing off, and then we're going to wait and see. So great opportunity right now to buy down the rate that way, and then wait to refinance, next 2 or 3 years. That's one way. As you mentioned earlier, the FHA, the new the loan amounts are out. What Martin County, St. Lucie County is $500,000.
Right.
So
you buy a super nice house for that.
Really nice house.
So with that being said, if you have any questions and you need for Brent, please leave a comment in the comment section. He's there for you. I'm also going to leave his information down in the information section below. Don't forget that I am a full-time real estate agent right here in South Florida and Brent's mortgage broker. So if you're looking to buy or sell a home anywhere in the Treasure Coast or Palm Beach County, my contact information is right there on your screen. Send me an email or log into my home site. We'd love to help you. And if you'd like to speak with Brent, again, I'll leave his information in the information section below and a link to his YouTube site, because Brent has a YouTube site.
That's true.
And as always, please leave a comment with any questions or concerns you have. Let us know. Also, if you've been out there looking at homes and what you're seeing as far as inventory and new construction, because I'm on the road every single day. I'm seeing the market, and we're definitely seeing it pick up dramatically. Had an agent I was showing houses, and PJ Verano said she had 11 showings for 2 houses. So, I mean, it's unbelievable. People are out looking, new construction selling like crazy. So we'll, it's the market is moving. So again, if you've had you've been out there right now, you're looking at inventory, you're seeing homes, let us know how you're doing and what you're seeing. And then if you like this video, please give us a thumbs up, like this video. I really appreciate it. Lets me know I'm doing a good job and you're enjoying the content. You can watch the next video on FHA and VA and how you can benefit from that right there. Be kind to each other, and we'll see you next time.